Evening to everyone. Thank you for taking out time and joining us today at this webinar. I am Shikha Sood and I head products at Edelweiss Asset Management. Today we have the privilege of engaging with Mr. Dhawal Dalal. He is the Chief Investment Officer Fixed Income at Edelweiss Asset Management. Dhawal has over 3 decades of experience in the fixed income domain and is here today to help us understand the key trends that are influencing our countries, India's bond markets, and how investors can strategically position themselves in the current environment. Thank you, Dhawal, for joining in.
My pleasure, Shikha.
And also, I'd like to mention to everyone that Dhawal is also here to address any queries or questions that you may have. So feel free to post them in the Q&A or comment box section, and we'll be happy to address them towards the end. So Dhawal, let's start with the bigger picture. So India's GDP growth has been revised down to 6.5% from an earlier number of 7.2% for FY25. Inflation number for Feb is also going to be out soon today, and that is also
already out, just out.
Okay, that's great. That's great. So even that is trending lower, and meanwhile, even the fiscal deficit is trending lower. So against this backdrop, how is India's macroeconomic landscape shaping up, especially as we head into the next financial year?
So Shikha, is a very good question to start this conversation with. From our vantage point, we are seeing that India's macroeconomic landscape is getting better. So one of the important aspect of the macroeconomic landscape, which was inflation, and in the third quarter, the inflation actually remained slightly higher, about 5.6% on average, is now trending lower. And as we speak, we just got the February inflation number, which was lower than the expected. It came out at 3.61. And that is going to take the fourth quarter average inflation below 4% in our view. So taking all that together, I think the FY25 average inflation is going to be close to about 4.7%, slightly lower than what the RBI's estimate was. And going into FY26, we believe that inflation is also going to be lower than 4.5%, or even closer to could be 4%. That is the RBI's midpoint of the inflation bracket. On GDP, it is important to note that the second quarter GDP number came slightly lower than the market's expectation, which was one of the reasons why the markets reacted the way it's supposed to be. However, going forward, we believe that Q3 GDP provisional number was close to 6.2%, and the fourth quarter GDP number is expected to be close to 7 quarter, thereby taking the FY25 average GDP number close to 6.5%. Going into FY26, we also expect that India's GDP will be at least 6.5%, if not higher, subject to a lot of market conditions. On the other hand, the other critical macroeconomic landscape, such as current account deficit, is very much under control, close to about 1.1, 1.2% of the GDP for FY25, and the same number could be expected into FY26 onwards. Now, the fiscal deficit, which is trending lower, I think that is very, very important from market perspective, because a lower fiscal deficit probably means lower borrowing by the government of India as a percentage of GDP, and thereby lower bond yields down the line going forward. That's how the mechanics work. The only point that we need to focus from a macroeconomic landscape perspective is the balance of payment. Now, given the outflow of FPI in the last quarter, that is a quarter ending December, and the continued net selling by the FPI in equities, we believe that India is going to have a negative balance of payment in FY25. And this will probably be a first year among many last couple of years that we are going to see balance of payment being negative. And that is what is getting reflected on our FX reserves and other parameters as well. And we hope that this balance of payment turns quickly positive in FY26. And that is something that we are watching. So other than balance of payment, all critical key macroeconomic indicators are looking positive going into FY26.
Okay, thanks, Dhawal. There is another concern in the market, which is around the banking system liquidity deficit. So what is driving this deficit, and what's the outlook for the coming months for it?
So Shikha, if you notice that the banking system liquidity has become a buzzword for the market participants in the last couple of months, because it has become such a boiling issue for both equity as well as fixed income market participants. So the story started in November. So prior to November, the banking system liquidity was neutral to positive. But when the FPI selling intensified and the Reserve Bank of India had to intervene to defend the currency, what they did is they sold the dollar and bought the currency back into the bank, out of the banking system, and that resulted in a significant amount of decline in the banking system liquidity. So prior to November, when the average liquidity was positive about 1 trillion rupees, because of the RBI's intervention and the selling of the dollar to defend the currency as well as to support the FPI outflows, we saw the banking system liquidity turn to negative 3 trillion. That means deficit of 3 trillion. So there is a 4 trillion rupees delta that we saw. But after December, I think Reserve Bank of India quickly understood that the banking system liquidity deficit is creating bigger problem for both money market as well as for sentiment. And as a result of that, the Reserve Bank of India has taken a series of measures, starting with first the CRR cut that released about 1.2 trillion rupees in December, and followed by several open market bond purchases as well as FX swaps. That is still ongoing in month of March. And so far, we believe that since December, the Reserve Bank of India is on track to pump almost 5.5 trillion rupees worth of liquidity in the banking system, and that should turn the liquidity conditions slightly positive as we enter into FY26 going forward. So I think from a liquidity perspective, I think most of the concerns are being addressed.
Okay. So Dhawal, with the liquidity interventions underway, RBI has also delivered its first rate cut in 5 years, bringing the repo rate down to 6.25% after maintaining a status quo for about 23 months. So, however, the CPCD yields have not declined as such
That's
as
correct.
expected. So, what is preventing the yields from easing? And so, my question to you here is, what's your view on two key points? One, the policy rates and the CPCD yields going ahead from here.
So on policy rate, Shikha, we are very clear that this Reserve Bank of India would do anything possible under their hand in order to support the economic growth. And the entire story that India's economic growth needs to be supported, and that now that the inflation concern is out of the window, the path to rate cuts have become very, very clear. And in my view, that the February cut was a start. We expect another cut in April, and the third cut maybe in the third quarter of calendar 2025. So all put together, we are going to see its total 75 basis point cut in calendar 2025, bringing the repo rate to close to 5.75%. Now, you are absolutely correct that when the February cut happened, we didn't see commensurate decline in the CPCD rate. And the problem was the transmission. And the transmission was affected because of the liquidity condition that we just spoke about. So because the liquidity conditions were in banking system liquidity was in deficit, we didn't see the transmission of the rate cut. And that is exactly what RBI has understood. And since the rate cut in the early part of Feb, the Reserve Bank of India has taken series of measures as we just shown on the table. And now the liquidity conditions going to be adequate. We see the transmission also becoming slightly easier. So we expect that the month of March, as you know, is a cyclical outflow month. We are going to see advance tax outflow taking place on 15th of March, and then there's a GST payment that will go on 20th of March. So all put together, the month of March is slightly tighter, which happens every year. As we roll into April, we expect the government spending to start and banking system liquidity also to turn positive. So with April rate cut, we see expected transmission of the rate cuts, cumulative rate cuts that we have seen. And I think CPCD yields should also follow the policy rate cycle going forward. So we expect the CPCD rates to also come down in April after the rate cut, and the banking system liquidity improves going forward. So this is probably, in our view, the great time to lock in some of the levels that are available in the market for investors who are looking to invest for at least 3 to 6 months.
Okay, great. So, with these macro and policy factors in play, how do you suggest the investors should position their portfolios at this point in time?
So that's a very important question, Shikha. And in our view right now is that given the state of the equity markets and given the state of other opportunity, I think fixed income market is now looking more appealing to the investors after a gap of at least 2 years. And in our view right now, investors with different kind of risk appetite could look at different kind of assets and the categories of fixed income schemes that is available to them right now. But from our perspective, I think there's a value in 1 to 3 year segment of the corporate bond curve. Because as we speak, the credit curve is inverted. That means short-term rates are offering higher spread as compared to long-term rates. And I think for clients who have been habituated to look at risk-adjusted returns, in our view, I think 1 to 3 year segment offers tremendous value for investors at the current level. Now, as we discussed, we are going to see at least 2 more rate cuts, and the banking system liquidity is going to improve going forward. So, based on that, we believe that this inversion at the short end is going to get corrected, and that means the short-term yields are going to fall at a faster pace than the long-term yields. And from the risk-adjusted returns perspective, we believe that the short-term rates will probably give better bang on the buck for the clients who remain invested for at least 6 months to 12 months at the short end.
Okay, great. So, Dhawal, you mentioned that the shorter end looks attractive. So, and therefore, a lot of investors are now looking at low duration funds as an investment opportunity. Our NFO of Edelweiss Low Duration Fund is also in progress. So, in your view, what kind of investors should consider these funds for their investment portfolio?
So Shikha, the money market segment and the low duration fund segment collectively is almost having almost 3.5 trillion rupees worth of collective investment from market participants. They are evergreen kind of funds in our view, and I believe that these kind of funds will probably give investors a slightly better return going forward, because we not only the rates are looking attractive current levels, but also there is a potential price appreciation likely to happen once the rate cutting cycle takes place in April, and the transmission of that rate cut, previous rate cut, will also take place going forward. So I think from a low duration client's perspective, anyone with having some amount of surplus that they are holding for at least 6 months, or investment horizon of at least 6 months, can take a look at that.
Sure, Dhawal. So, at this point, I'll just like to remind our participants that in case you have any questions, please feel free to post them in the comment box, and Dhawal shall address them.
Sure.
So, Dhawal, while you did mention on the attractiveness of the shorter end of the yield curve, and you did give us a sense on a broader basis on the bond markets, but so while the investment opportunities look compelling, but what are the key risks in your view?
Yeah. So Shikha, we cannot discuss any kind of position without talking about the risk, because that's the risk and reward are the two sides of the same coin. So from our vantage perspective right now, there are a couple of risks that one has to be cognizant about. And number one is that the risk number one is the US 10-year yield direction. Currently, as we know, that the 10-year USD yields have declined and now close to about 4.3%. But if the yield starts moving towards 5%, then it will put tremendous pressure on the emerging market bond yields as a asset class. And this is something that we need to be cognizant of. So whenever the US 10-year yield are trending towards closer to 5%, that's all bets are off kind of scenario. That's risk number one. The second important risk from internal perspective is the economic growth. Now, Shikha, you must appreciate that the government of India is doing everything to ensure that the economic growth remains 6.5% or higher. In fact, we should aspire to grow at least 7% for next couple of years in order to remove the negative impact of the COVID-related slowdown. Having said that, I think the lot of our positive aspect of the economy banks on the economic growth, and if there are whatever reason, if the economic growth comes down sharply going forward because of external environment or because of tariffs or whatever we are talking about, it will have a cascading impact on the tax collection, it will have cascading impact on the government spending, cascading impact on the government borrowing, and so on and so forth. And these are some of the things that will probably have negative impact on the investor sentiment as well. So these are the two critical risks that we are focusing on, but we believe that at this point of time, these are the risks, and the likelihood of them is pretty low, but we'll keep an eye on them.
Sure. So Dhawal, there's another question on the fundamental relationship between equity markets and bond yields.
Yeah.
So if you could just help us understand on whether how our Indian equity markets typically react or how bond yields typically react with respect to equity market movements.
So generally, the way the rule of thumb is that if you are having a price P ratio of 20, hypothetically, that means inverse of 20 is 5%, right? And generally speaking, the market participants would like to compare the what are the 10-year bond yields level are and what is the equity risk premium or the inverse of P ratio is looking like. And whenever there is a larger gap, that makes the bond market more attractive, and particularly if the outlook on the equity is that probably range bound to slightly declining, that's when we will probably see more interest coming into the bond market, and that's a mathematical relationship that we are seeing. Having said that, this kind of relationship has been not been proven empirically, primarily from the fact that the investor classes are different. Bond market is predominantly institutional investor driven, and these guys have a regulatory requirement to invest money in fixed income. Whereas the relationship we just discussed about for inverse of P ratio is pretty much applicable to those investors who can move from one asset class to the other. That is pretty much retail investors, HNI, family offices, and others. And they normally tend to look at this kind of asset class and see if they can benefit from the attractiveness of the bond market while the equity market is looking range bound at this point of time. Now, so yes, we are going to be happy to see some amount of flow coming from equity market to bond market based on this measure alone. But we also have to keep in mind the taxation aspect. And this relationship does not take into account the taxation aspect when we move from one asset class to the other and from other back to the original one based on the investor's preference. But on paper, yes, whenever the equity markets are looking at expensive and bond yields are slightly on the higher side, that's when we probably see that the bond market looks attractive as compared to the equity market. I hope that answers the question.
Yes, yes, absolutely. So, Dhawal, another question is around, so up to 1 year, there are other opportunities also available under fixed income mutual funds. So, what would you suggest, or who would you suggest, say, a money market fund or a liquid fund versus a low duration fund too?
So I think as we have seen from the relative return table perspective that we have just presented, and if you could just show it again, you'll probably notice that in terms of liquid fund to money market fund to low duration fund, I think the fund with higher mod duration, which are the low duration fund and money market fund, as we have seen through median duration number, one should focus on the fund with slightly higher duration if it comes within your risk appetite category, because the rate cut cycle is trending lower, right? And we are expecting one cut in April. The other cut could be in the second half of calendar 25. So whenever there's a rate cut and the banking system liquidity is in a positive mood, we are going to see potential price appreciation in such schemes where the relative duration is slightly on a higher side. Now, we know that liquid fund operates up to 3-month average maturity, 3-month duration bucket, and with average maturity is close to about 45-50 days itself. Whereas in money market, it can operate from 0 to 12 months, with normally the duration between 6 months to 8 months. Whereas the low duration fund as a category normally operates, suppose regulatory requirement is 6 months to 12 months. But if we see the duration range, it's mostly between 9 months to 12. So in such scenario where we are going to expect a rate cut from the RBI and the banking system liquidity turning positive and the transmission of the rates going to be easier, we believe that the scheme with slightly longer duration, within 1 to 3 year bucket, is something that is going to be beneficial for clients if they remain invested for at least 6 months.
Sure. And in this comparison, Dhawal, there's an added question on what about arbitrage funds? So certain people also consider for a 3 to 6 month horizon, also consider arbitrage funds as investments. So yeah. Who should consider what kind of product?
So the difference between arbitrage fund and low duration fund, apart from the attractive taxation, is the fact that the arbitrage doesn't have a clarity of the return beyond a month, right? because it every time there is a settlement in the last Thursday of the month, that's when you get to know what is going to be the expected return for the next 1 month. Whereas, and so that's a variable. And particularly when the markets are range bound to slightly weak sentiment, that's when the arbitrage opportunities also disappear. And as a result of that, we have seen that the arbitrage fund in terms of returns tend to start lagging liquid fund returns in such period. So if the outlook that the equity market is likely to remain range bound, then the relative return perspective, the gap between low duration fund and arbitrage fund could widen in favor of the fixed income funds.
Okay, sure. There's a question on, is there an exit load? So I'll take that one. So no, there is no exit load for this product.
Yeah.
There's another question on, so with the so is this product, can this product also be considered by, say, retail investors with the change in taxation of debt mutual funds?
Well, as of now, yes, this product is suitable for all kind of investors, provided the holding period is at least 6 months. The asset class is fast growing, and it's been net inflow in the last 6 months. As we can see, about 4,000 odd crore have come into low duration fund as a category, and that probably shows growing interest of investors, of different type of investors in the low duration fund as an asset class. Now, what was the second part? I forgot.
No, it was the same thing on taxation related, that post a change in taxation, specifically this particular product also can be, or debt mutual funds in general can be attractive to retail investors.
Yeah, so now all fixed income funds are at a marginal tax rate. So depending on the investors' marginal tax rate, that will be the taxation applicable to low duration fund as well, along with other fixed income funds.
Yes, I'll just add there that with the revision in tax slabs, and also with the increase in tax rebate to 60,000, therefore up to, if the income is up to 12 lakhs, there's not going to be any taxation applicable, and there's going to be nil taxation for anyone up to 12 lakhs.
Under the new tax regime.
Yes. And so Dhawal, there's also a question on long duration bonds. So what's your view on the longer end?
So interesting question, honestly speaking. So right now, as I mentioned, that the credit curve is inverted, right? And as a result of that, we have seen more spread over the risk-free rate, risk-free government bond at the short end. Now, at the long end, that means I presume about 10 years onwards, what we are observing is that the spread between SDL and GSEC, that means state development loan, and the government bonds of the same maturity, up to 10 years, it has widened to 50 basis point. It used to be close to about 30-35 basis point not so long ago. Now, in the last 2 months, for whatever reason that we know, the spread has widened to 50 basis point. Now, all institutional investors, such as insurance, pension funds, and other investors with regulatory investment class, in my view, will probably focus more on SDL, because SDLs are also considered risk-free. And if you're getting 50 basis point more, then why not? And from that perspective, we believe that SDLs will probably get higher market share of investors' wallet into longer end. As a result of that, if the spreads remain at 50 for longer period, then we believe that the GSEC interest will also become slightly less from institutional asset class, because if you're getting 50, normally you will probably go for that. And this is also pushing the AAA CPSE spreads over GSEC wider than 50. I hope you understand what I'm saying, because SDL is pushing everything up. It's like, and as a result of that, what we are seeing is that the as you can see, the funds where there's a higher allocation to longer end of the corporate bond, they have underperformed, and this is something to keep in mind. So while we are looking at rate cut cycles and other things, it is important to note the dynamic of interplay of SDL spreads with AAA CPSE spreads and the performance of longer duration funds with exposure to AAA CPSE.
Sure, sure. And in addition, Dhawal, it will help if at this point you can help in differentiating between the two offerings. So there, just to clarify or to clear any confusion on, it is not low duration or the shorter end versus the long end that you should be considering for investments. Considering your investment appetite, your investment horizons are different. So you could further clarify on the type of investors who should consider these two type of products.
So as I mentioned, the low duration funds have an average maturity between 6 months to 12 months. So this is exactly, and clients, if you are investing in low duration fund for an investment horizon of at least 6 months, which is matching the duration range of the fund, that is something that one should consider for investors with low risk appetite. But if there are investors who are looking to lock in attractive rates right now, hoping that there is a rate cut cycle taking place, and the wider credit spreads are offering attractive opportunity for clients to lock in money for at least 2 to 3 year investment horizon, then they can also consider investing in longer duration funds like dynamic bond fund or any other passively managed bond ETF or bond index funds, investing in 10-year plus corporate bonds or PSU bonds.
Dhawal, your view on global interest rates, considering US debt?
So honestly speaking, that global bond yields are becoming very, very volatile. In fact, in month of February, we saw the US 10-year, which was trading close to about 475, falling all the way to 410 as the fears of Trump induced tariffs and the fear of recession pushed the 10-year yield lower. Now it is slightly back. But apart from the US, we are seeing that German 10-year bond yields are trending higher. The Japanese 10-year yields are trending higher. And there are client-specific or the country-specific risks which are responsible for such upward movement. Having said that, in our view right now, all countries are going to take measures to protect their own interest. And as my view is that the biggest country risk is from the US. And right now, as long as the US 10-year yield remain on a lower side, it is beneficial for emerging market bonds. But if the US 10-year yields reverse the course and start trending towards 5% for one reason or the other, then it will be a magnet. It will like a vacuum cleaner, will take away all the surplus liquidity which is going through the emerging market and take it back to the US, and that will be negative for the emerging market bonds. So this is where we are right now. So we need to watch for the US 10-year yield movement and hope that it remains where it is or even trends lower.
And Dhawal, in the beginning of the session, you did touch upon the USD INR expected movement. But if you could give a little more detailed reasoning for the same.
So we expect the rupee to depreciate about 3% to 4% in FY over the next 1 year. And historically speaking, the rupee has depreciated by about 2 to 2.5% on the last couple of months, barring the last quarter, wherein it depreciated about 3% absolute in the last quarter, say November onwards. So that has been a big adjustment for the currency, but assuming that there has not been any earthquake-like kind of movement, then I think we should see a gradual depreciation of the rupee against the dollar, maybe slightly higher than the one we have seen recently, but should be closer to between 3% to 4% in our view. Unless there is a significant amount of development in our economy and our growth collapse, and there is a further outflow of FPI, but that's not our base case.
Sure. So Dhawal, for the low duration fund, how do you intend to structure the portfolio? If you give a little more sense on the underlying securities.
So currently we are in month of March, and March is a very crucial month to lock in higher yield. So whenever we are able to close the NFO on I think 18th, our first objective will be to lock in the asset class in form of bank CDs and commercial papers initially. And the reason for that is that as we expect a rate cut in April and the liquidity conditions to improve going forward, we believe that the bank CDs will be the first one to react positively in terms of potential price appreciation. Then once we are able to capture that move going forward, we will probably rebalance the portfolio in such a manner that it will be a combination of corporate bonds, both AAA and AA plus, so some amount of government securities based on the regulatory requirement, and some amount of CPCDs to ensure that the portfolio duration of the low duration fund remains between 0.75 to 0.95.
Sure. Thanks. So Dhawal, that was it from our end in terms of questions. Any closing remarks from your end?
No, in fact, it's been a good beginning of FY26, if I may say so. I think the clients are once again looking afresh at the fixed income after a gap of 3 years, and we are very, very energized. I believe that the Reserve Bank of India is going to support the fixed income market by way of pumping more liquidity, buying bonds from the market, and through rate cut cycle. I believe that calendar year 25 or FY26 going to be another great year for the bond market participants, and clients should just appreciate that fact and positioned appropriately in different kind of asset class based on their own risk appetite, but ensuring that their investment horizon should remain at least 6 months, in my view, to be able to benefit from the potential price appreciation through rate cuts.
Okay, sure. Thank you very much, Dhawal, for your insights and expertise, and thank you everyone for joining in. We appreciate your time and look forward to more such conversations on the fixed income markets. Thank you very much.
Thank you. Have a great evening.